most of you. So hopefully you'll get something out of this, and maybe a few things that we'll talk about today will ring some bells. And as always, you can reach out to Jonathan and myself if you want to have any follow-up conversations or continue go a little deeper into any particular subjects. We can discuss that. So basically what we're doing here is we're trying to provide some basic corporate finance literacy to people who are not in the finance and accounting areas of a company. We do this because obviously it improves communications between the departments at a fundamental level, and this leads to improved performance throughout the organization, which eventually trickles its way all the way back to the bottom line, which is where I get excited as a CFO. But that's kind of the roundabout high level a goal here of what we're doing, what the program is designed to do. The best workplace it exists to improve organizations in all different areas, and this happens to be one of them. So while you're not going to get an MBA out of this, hopefully you're going to pick out a few things that will ring some bells. For me, I'm not an accountant. I'm actually an engineer in the Wayback Machine. Turned that into a couple of decade CFO career, practicing CFO. Ended up working with a company, brought it from startup all the way to a nationwide financial services firm. Eventually, that company was sold, and now I consult and work with companies of all different disciplines and help them with their financial and operations strategy. Is what I do as a CFO. We're going to go a lot into conversations about, what does a CFO do? What does he look at, and things of that nature. So that's kind of where we are, who I am. There's not much more to say about me. We can ask anything you want to as we go. But that's about it for me. Jonathan, anything else you want to tap onto me other than the fact that I'm actually a CFO who likes to talk to people?
Yeah. So yeah, Steve, you are a rare breed in many different ways. But yeah, certainly, folks, as we go through this program, I'll be monitoring the chat. So if you do have any questions for Steve, please place them in there. Also, this so far is a relatively small group. So if you do have a direct question, let's use Steve's expertise. Just, I would ask that if you could just raise your hand so that way we can do it in an orderly fashion. That would be great. I appreciate it. Okay, so recording it. Okay. So with that said, Steve, we're gonna move on to the first topic here. So
Sure.
what is
So generally
finance?
what we want to talk about is what is finance, and we're going to distinguish it from accounting and a few other things that generally get lumped in with it. But a CFO is Chief Financial Officer, and finance is a couple of things. One is it's a process. A CFO, as the Chief Financial Officer of a company, is actually an asset manager. I, as a CFO, am responsible for not only the money asset of the company, but all the other assets of the company. There's our tangible assets like cash, like machinery, land, equipment, desks, furniture, all that sort of thing. But I'm also some of the intangible assets I'm also responsible for. Oftentimes we have personnel, staffing. That's we all know that's always considered the most valuable asset of a company. So that's something else that a CFO is often charged with overseeing. So when we track assets, I guess the way I always talk about it is my job is to determine what do I need, how do I get it, when I obtain the asset, how do I deploy it within an organization in the most effective way possible. And I use data and numbers to drive all of that, which I'm not going to bore you with today, but that's the mindset I have as a CFO. Then we have on the other side the functionality piece of being a CFO in working in the finance. So this is where we get into more of the accounting end of it, because the accounting end of it is the tools that I use to be able to do my job, to allocate those assets rather. Accounting is actually a way to standardize what I'm looking at in one business as opposed to another business, which may have a different functionality to it. So how do you compare two different companies who have different strategies, different markets, and yet be able to draw some kind of comparison between the two of them? And the way we do that is we actually create fairly standardized financial statements, so that we're trying to take an apple and an orange and make it look like we're actually looking at two apples or two oranges. That's effectively what the whole accounting function is. So that standardization is where I need to rely on a lot of other professionals within the accounting and finance area of the company. So let's talk about this a minute. You can go flip to the next one. Jonathan, what is the difference between the finance area and the accounting area, with the CFO usually riding over the top of both of those? Well, in the finance area, we look forward. We take the reports and the tools that the accounting folks provide us, and we work with senior management, C-suite, executive, CEO, et cetera, to map a road forward. We develop the financial strategy for the organization. And that's also where we begin to tap into all different departments of the organization, like the talent development people. Obviously, that development of the talent asset is incredibly important to us. And so that's where we begin to really interact with you guys, asking you, not maybe if we don't ask it, what we're trying to get to is, how long does it take to develop a particular person in a particular area? We have to build that into our models and take that subjective information and try to translate it into an objective measurement and an objective model. So that's kind of where we start working. Now let's talk about who the various folks are. In the accounting end, you've probably run into these folks all the time. In the accounting end is your bookkeepers, your controllers or comptrollers, your CPAs. By the way, does anybody know what the difference is between a controller and a comptroller?
It's a super wonky question.
Wonky question, but doesn't involve math.
No, don't know.
The answer is actually sometimes they're used interchangeably, but generally a comptroller is a controller, but they work in in either government, of course, or nonprofits. That's typically where they work, but they effectively do the same function. And what they usually will do is they oversee the bookkeepers directly, who are making the actual daily number entries into the books and that sort of thing. But a point that I'm trying to stress is that these folks, bookkeepers, controllers, and CPAs, they work generally on the accounting end of things. And what they are doing is they're responsible for telling the history of the organization, the financial history of the organization, as accurately as possible under a very specific set of standards from the past through today. That's their function. Where the finance people get into play, like the CFO, is we take that story, that financial story, and we project forward. We project forward with forecasts and budgets and all of that stuff. And that's where we start reaching out and tapping to multiple other departments, asking for that information to accumulate into our comprehensive forecast. It's also where we sit, as I mentioned earlier, we'll sit with the CEO or the owners of a company and begin to map financial strategy going forward 3, 5, 10 years out. And what's the long range goal and how do we get there? So that's a difference of mindset between the two. It's also probably why I, as an engineer by training, was able to turn that into a multi-decade CFO career, because as an engineer, it's all about problem solving and looking forward and engineering a financial solution, in this case, for the organizations I work with. So this is, we're going to get a little bit wonky. I'm trying to make this as interesting and high level as possible so we don't get into the weeds on this, but we're going to have to talk about financial statements. Financial statements are the backbone of what the finance folks use. And when I'm discussing these with you guys, I don't want you to worry about knowing all this information in the sense of being able to recreate it on the fly. I really want to talk about it with you and so that you have some understanding of what some of the terms you've probably heard are, where they fall in the pantheon of the financial statement, and why why you're often being asked about, and how does it aid the organization going forward. So interrupt me, please, as we go, if you have any more specific questions. But at a high level, there are three basic financial statements. And we're going to talk, the first one we're going to talk about is the balance sheet. Now, the balance sheet takes a look at where does the company stand financially at a given point in time. So we're measuring what do we have, what do we owe, and hopefully, if we have more than we owe, we have something left that's called equity. And the equity is obviously the paper value, if you will, of the company. Now, as an aside note, in the longer term class that we would do is there's a whole section we go into drivers of business valuation and things of that nature. So if that ever is something somebody has an interest in, we can cover that and go into more details about what are the items that that you need to focus on if you're actually trying to improve the value of your company above the general overall profitability of the company. But we're not going to go into much of that today. So there are three sections to a balance sheet. The assets, which is what we have, what the company owns. Liabilities, what they owe. And as I mentioned, the owner's equity, which is whatever's left after you pay off everything you have, and that's what the owners of the company get. And we're called a balance sheet because on one side of a seesaw, if you picture a seesaw in your mind, you have the assets. On the other side of the seesaw, you have the combination of the liabilities and the owner's equity. And the balance sheet, by its name, is always balanced. So if I have $5 million of assets, I need to have $5 million worth of liabilities and owner's equity. As the math here, this is the only math, no real numbers, just concepts. You can see that if we keep that seesaw balanced, our financial statements will be at least mathematically in order. And that's what I'm focused on. So what happens is, let's say cash is an asset, right? Cash that's in a company's bank account. Some other assets would be hardware, equipment, machinery, office furniture, et cetera, that a company owns. Liabilities could be loans, business loans that may need to be paid, bills to be paid that have not yet been paid. Those would be some examples of liabilities, monies owed out, or services yet to be performed that you could put a dollar amount on. So for example, if you are in a consulting service or you're and you get prepaid, for some services and you have yet to deliver those services, well, you have the cash in one hand, but you still owe somebody something at that point because you haven't done those services. So that's a liability that's on your books because you owe it. And as you begin to perform those services, you begin to pay off that liability. So that's something to think about as well. One of the items I was thinking about here is when you think about keeping the seesaw in balance, a general question to you would be, what happens to the owner's equity, the value or the paper value of the company, when I take, let's say, I take $1 million and I buy a piece of equipment. So the balance sheet looks, ahead of time, it looks like I have $1 million in cash. And then I convert that $1 million into machinery. What happens to the owner's equity of the company at that point?
Anybody venture to guess?
Wouldn't it decrease?
The answer is it doesn't decrease. All I've done in that scenario is I converted one type of asset to another asset. I took cash, $1 million, and converted it to a new asset on the books, machinery, let's say. So the owner's equity changes not at all. Now, we're going to come back to this because when we get to our third and maybe the most important statement of all, when we start measuring cash flow. But this is a concept that you have to factor in, is that the balance sheet is always in balance. Now, if I spent cash or if I gave cash away, then the owner's equity would decrease. So if I'm the owner of the company, for example, let's say I have a small business and I've got just for round numbers, $100,000 of assets and $80,000 of liabilities and $20,000 of owner's equity, and I take $10,000 out of the company, at that point, the owner's equity has dramatically decreased by $20,000 because my cash has dropped by 20 or 10 or whatever I take out, and therefore my owner's equity would. So if the asset actually leaves the company, then your owner's equity is decreased. So that's the thought process you want to have, keeping everything always in balance. So where did the asset go to? The balance sheet, by the way, is the second least understood or the second most understood of the three financial statements. The one we're going to talk about next is typically, well, before we go to the next one, let's think about some other things that might be on the balance sheet.
Yeah, and Kyle has a question. Kyle?
Oh, I'm sorry. I see the hand there. Kyle, what's up?
So Steve, with that, I mean, I get the balance portion of that. So if you purchased $1 million piece of equipment, how do you compare that to the depreciation of the equipment itself over time?
Okay. You want to go into depreciation? Okay.
Well,
so what happens?
Relatively speaking, I'm just trying to make sure it'll continue to balance based on what you're purchasing in comparison to the owner's equity.
Correct. Okay. Well, let's talk about that then. So what happens is, at a high level, without everybody's eyes glazing over, is let's say I buy 100,000, or let's make math simple. I buy $70,000 worth of equipment. And what happens is on day one, I convert $70,000 of cash to $70,000 of equipment. That move right there, as we just said, does not impact owner's equity, does not impact the P&L, the profitability of the company, because I've just taken one $70,000 asset and converted into another one. So there's not a P&L loss or an income or revenue. There's no income event or expense event by me doing that. But that asset, as you get into depreciation, is me expensing that $70,000 out over time, usually 7 years in the case of this type of material. So $10,000 a year. So what I do is every year I take $10,000 of the value of that asset and I charge it to depreciation. When I do that over time, picture the balance sheet, that asset is going to drop $10,000 a year, and my owner's equity section is going to drop $10,000 a year. So that's where we begin to have the owner's equity impacted. And it gets impacted through the next financial statement. When we get there, we'll talk about it, which is the income statement.
I got you. So initially, there was no impact to the owner's equity. There's impact over time as it continues to depreciate is the consideration.
That's right.
Understood.
That's right. And so, yeah, so what the IRS says is, well, we're not going to get into what the IRS says. We don't want to talk about those guys. So let's move into the income statement. Every income statement, like a balance sheet, has general sections in it. The balance sheet has three main sections with some subsections in there. The income statement has two very large sections, but those are also broken into subsections, if you will. But and everybody's income statement has these same sections in there. First is what's coming in. Let me step back. Balance sheet, as we talked about, is a snapshot in time. The income statement is performance over a period of time. So your income statement will always be January 1 to 12/31, maybe the first of each month to the end of the month, maybe it's over a quarter. It's over a period of time. So that's a mental distinction you have to make when we're talking about either balance sheet snapshot in time or income statement over time. So and we're going to get, when we get to this, the end of this, you'll see how they tie together. But over time, let's say I'm making, I'm a business of providing whatever service I have. I'm collecting sales and revenue money. So I have money coming into me. That's my top line. And you'll often hear about companies hyper focused on the revenue, right? That's what they're always on their sales force about. Bringing in that's as much as they're going to get is whatever they're bringing in via sales typically. From that, they begin to apply something called cost of goods, which is these are the expenses that are needed to be incurred to directly produce that revenue. What would this be? Well, if I'm manufacturing cars, in my cost of goods would be, of course, my metal, parts, that sort of thing. That would all be in my cost of goods, because obviously, if I buy tires to put on my car that I sell, the cost of that tire is a direct expense needed that I need to incur to produce that car. And that's why it falls under cost of goods. Some other things that might fall under cost of goods is oftentimes if I have if I'm paying out a commission, again, we're talking about a process where I'm paying somebody a commission, which is directly tied to the revenue they're generating. That would be considered a cost of good. So these are again, are expenses I need to produce that good or service. And when I'm done with that, when I take that away from the revenue, I get something called a gross profit margin. So in theory, the gross profit margin would be the same if I'm doing it, if I'm producing XYZ widget, or the guy down the street was doing the same thing. That gross profit margin would be the same in theory. Where it's different is where you get people looking to buy companies and things like that. Because if the guy down the street is able to produce this car cheaper than I am at a gross profit margin, I want to know what they're doing. Or if I'm able to produce it cheaper than they are, this is all going to trickle to my bottom line. That savings is going to trickle to my bottom line. I'm acting more efficiently. So I guess efficiency would be the way I would say it. So your gross profit margin is a good measure of your financial efficiency in producing the good or service.
Yeah, and I would add to that oftentimes when, like private equity companies, VC companies, when they're evaluating companies, that's usually one of the first places that they will look, is, so what sort of gross profit are you obtaining compared to your peers?
Right.
It's a good kind of top line measure.
That's right. It measures, yes, that's right. So it's a good way to compare. So, but we have other expenses we have to pay in our business that are not directly tied one-to-one or some percentage of revenue. They're not tied to that. That might be the rent on my building, or the mortgage on my building if I'm buying it. For example, my rent on my building is $30,000 a month, or my office space is $30,000 a month. It's $30,000 a month, whether I'm selling $100,000 worth of widgets or $200,000 worth of widgets. My lease says I got to pay 30. So that's what we get into a fixed cost, or we call it SGA, selling general and administrative costs. So these are costs that are not, that the size of the costs are not tied directly to the amount of revenue I'm producing. Got bad news for you guys. The other cost that falls in here, salaries. Payroll and salaries fall in here as usually a big one in certain companies. Again, your salaries being paid is not tied directly to the revenue, which is why hopefully if the revenue doesn't drop so bad, you have to start either laying off people or reducing salaries. On the other hand, you have to make, as a CFO, I'm making decisions that, hey, the revenue builds to a certain point where we need additional staff. Where's the trigger? How much does the revenue have to grow before I bring in a staff? I need additional staff. And that's where I come to you guys and say things like, how long does it take to train somebody up or develop that talent? Because I'm doing the math saying, I've obviously have to have that person in place, ideally trained up and working at an ideal world, exactly the time that I have the revenue up to the point where it can cover their cost, the cost of that new employee. So that's part of what me as the CFO, I'm trying to model out when I'm talking to you guys about, or talking to you, or I'm soliciting information about train up times and cost to develop talent and that sort of thing.
Excuse me, sir. I have a question.
Sure.
I thought you had said though that like cost directly associated with sales goes under cost of goods sold. So wouldn't that also include the salaries of salespeople?
It does. So oftentimes salespeople have a base salary plus commission. So I actually have to allocate their compensation in two places. I allocate the salary portion, the fixed portion, the non-related to revenue portion under SG&A, operating expenses, and the commission piece I have to allocate directly to cost of goods.
Where would you put health benefits?
Health benefits, well, let's think about that. I sign a contract with a insurance company, and I'm going to pay X number of dollars of health care, probably dependent upon a head count, is what I've got. That is totally independent of the amount of revenue I'm bringing in, right? Health thing. Yeah, so it falls under SGA, correct.
Gotcha.
And unfortunately, as we all know, it's getting to be a bigger and bigger cost, right? So, and that's why when sometimes we get the bad reputation of cutting back type deal, we look at the SG&A. Is this an area? Is there anywhere in here we can cut or reduce expenses? Because these expenses, as I said, don't relate directly to the generation of revenue. Now you need them. You can't cut too far, right? Otherwise, it will impact it eventually. But it doesn't directly, like immediately impact it. It can impact it pretty quickly though. So that's where we get our fixed costs in there. And then we end up with an earnings number. We're not going to go too much into EBITDA on this course. We go into a lot deeper into it on a later course, and nobody wants to talk about taxes anyway. And then we end up getting, after we factor in our depreciation or amortization, then we end up with our net profit, net income. Now, that's how much profitability we get on let's say it's a monthly basis. Now, how does this translate to the balance sheet? Well, in the balance sheet, as part of the owner's equity section, that last little section there's multiple lines in there. And one of the last lines in there is net income. So basically, if I have if I create $10,000 of profit this month, or $100,000 of profit this month, and I haven't increased any liabilities that I have, and let's just say the $100,000 is straight cash. So it goes into my asset as cash goes up $100,000 because of the $100,000 of profitability I had. My owner's equity just went up by $100,000 because the balance sheet stays in balance. But the real point is that when if you're ever looking at a balance sheet, the last item on the balance sheet is almost always going to be net income, and it will always tie to the exact net income number you're looking at over the same period on the net, or at the same period on the net income statement or on the P&L. So they're always they're always tied together, but they're reflecting slightly different items. Oh, all right, you guessed it. Okay, let's talk about this third statement, the least understood statement of them all, and the one
Your favorite. And isn't this your favorite?
It is my favorite because this is the one that's to me is well, they're all important, but the one that almost nobody looks at, but is so incredibly important. The question I get from customers and clients all the time is, Steve, my CPA is telling me I'm making a lot of money. My company's making a lot of money. I know I am. I'm making more money now than I made last year because I'm paying a bigger tax bill. Yet when I look at my bank account, I have less cash. How is that possible? I get some form of that question a lot. And that's where I say, well, what you're asking is, where did my cash go? And that's what the cash flow statement does. The cash flow statement says, we look at your profitability, the net income from the income statement, and we say, how does that relate to your cash position? Think about this. Every business out there, every for-profit business out there, produces some good or service as their primary product or service. I would suggest that every for-profit business out there has a second product that it produces, and that's cash. If I'm a sole proprietor, I'm an entrepreneurial person, I build a company, I'm probably doing it. My primary reason for doing it is to secure cash for my family, so we can live the life that I want to provide them. And it's only the cash that I'm able to pull out of a company and buy, and pay my mortgage, pay my own personal bills. I can't do that with the machinery asset that's in my company, right? I need the cash asset. So what I tell every business owner is, you have to manage your cash just the same way you manage your products or services going out the door. And that's where this statement comes in. What it does, it generally says, how much cash did we produce from our general operations? So that's just the general work of just running the business, producing the widget or delivering the service. How much cash did that produce? In there, if we go back to Kyle, you asked a question about depreciation, for example. In our example I gave you, I said there was a $10,000 expense that we put on the books to reduce the value of that asset. But when I did that, when I dropped that asset $10,000, I didn't hand out $10,000 of cash when I did that. The cash position didn't change. So what we do is we adjust the profitability from the operations of the company. We adjust it for these, let's call them non-cash expenses and income, like depreciation. So at the end of the day, I can say, me running this business for this month, I increased, because of the operations of the business, I increased the cash in this business by, let's say, $100,000. That's a starting point. Now, where else could my cash go? That's how my cash comes in, is assuming I'm making something profitably as on the income statement, producing something profitably as on the income statement. Where else can my cash go? Investing. I take $100,000 of cash and I buy some equipment. Well, what I've done there is, as we talked about right off the top, is I've not hit my P&L. That doesn't attach to my income statement, but it certainly impacts my cash position. So any investment that I do, like buying or selling equipment, can either add to or decrease the cash being brought into the business. The final piece that we look at that can impact my cash position is financing. So this could be me paying off a loan. If I pay off a debt with cash, that would decrease the cash position. If I, as the owner, take money out of the company, that decreases the cash position. If I, as the owner, put money into the company, that increases the cash position. If I, as the owner, go out and get a loan, we all just went through this 2 years ago, these PPP loans that many good companies got. I go out and get that $200,000 PPP loan, my cash position goes up by $200,000, and on paper at that instant, even though they were never paid back, but initially you owed that money initially. And so that increases the cash position. And these are all examples of the cash position and going up and down without ever impacting the P&L of the company, because these are not part of the operations of the company, if you will, to produce the widget or service. When we do this, when we look at this report, then at the end of it, it says, Here's your net increase or decrease of cash over the period we looked at, and why did it happen? Here's your operating P&L. Here's cash went in or out due to investing. Here's cash that went in and out due to financing activities. Here's the net increase or decrease in your cash flow. And that answers the owner's question. How is it that I'm making all this money on paper and profitability, and I don't have any more cash in my bank account? And it's because I turn to them and say something like, well, you had to invest $1 million into new equipment. That took your cash. So we project and forecast not only profitability of the company and revenues, we also forecast cash positions, because without the cash, we can't pay the bills. And now you run into a situation that we call, you grow yourself out of business if you're not careful. Because if you can't pay your bills because you're growing so fast and you're utilizing all your cash elsewhere, then you're out of business. So it is possible to grow too fast. And that's where also as a CFO, we come in and we start putting in structured and planned growth plans to ensure that that situation doesn't happen. That's also why we go to talent development folks like you, and we ahead of time, hopefully, and say, we are going to need people who do X, Y, Z 6 months from now. We need to start on it now. That's kind of how that all ties together on our cash flow. So does anybody have any questions on that, on the statement of cash flow at a high level?
Yeah. So folks, I'm as you can see, I'm taking a lot of notes here. And one thing I do want to say is we will have the slides available. I will ask that you click on a Survey Monkey or capture the QR code, because there's other information that we would like to share with you as well. Information that's been helpful for me as a VP of training and development in a previous life. Learning this information has really saved my life in many ways. It's been extremely helpful. And I see Kyle, another question. Have at it.
I do. So thank you for this information, first of all, because man, this was helpful. It's very insightful. So from an HR perspective, as well as training and development, knowing that we may need some hires in the future, what then is the approach to ensure that you don't, grow yourself out of business, as far as like, I guess trying to figure out where the revenue points need to be in concern with the growth needs of the future. How do you work that out?
Well, you actually go the other way with it, Kyle. You look at, you start with where do I either want the revenue to be, or is it going to be just due to, let's just say, the general organic growth of the company or the market? So if I know that I'm going to be due to market conditions or want to be 40% higher in 2 years or something like that on the revenue, now I work backwards and say, because again, I'm the asset manager, right? I'm the CFO. So I say, okay, what do I need to have in-house, both tangibly and intangibly, or personnel wise, to support that level of revenue? And what's it going to cost? What does it cost me to bring those new assets in? And I hate it. Don't get me wrong. People are, the talent. I don't want to sound indelicate. It's not indelicate. It's just a statement. It's just people are worth X dollars on the paper, and I just have to budget for the expense that I'm going to incur by bringing those folks on. So what I do is hopefully I'm in tune enough with the organization that after I talk to folks like you, I understand the ramp up times. I understand what the costs are going to be. I'm constantly in touch with, updated. I mean, look what's been going on for the last 2 years, plus, especially the last year with talent acquisition, how expensive that is and how difficult that is. I'm very familiar with those problems. I'm usually in many conversations with the HR managers and talent folks, because I have to know what that's going to cost and how do I budget for that. It's also why, as Jonathan talked about, the drudgery of the budgeting. what I'm doing with that information is how do I work that into my model? But I guess, Kyle, to back it up, to reiterate, what I would do is I would start with where am I going to be, and then back up from there and say, what are the assets and resources and personnel I need to have to be able to develop to support that level of revenue.
Yeah,
I got it. Thank you.
yeah, and Kyle, that actually dovetails into the next section that I'll kick off a little bit, but Steve, certainly feel free to insert your CFO opinion on this. So I, again, used to suffer a lot of anxiety whenever I would be asked to put together the budget. And where I would typically start is, and I'll share my screen here, where I would typically start in, if anybody's ever gone through this, where, finance accounting has reached out to you and said, okay, time for the yearly T&D budget. So we want you to look into your crystal ball and figure out, okay, how much money do you need? What sort of growth do you anticipate? Typically, where I would go, what I would start with, and I'm sorry, my screen just went a little nutty here. Let me try this again. Typically, where I would go is I would start with, I would spitball it. And I don't know
Before you go any further, I just
Yeah.
let the record show that I'm not the one who introduced math and numbers into this. It was you.
Yeah.
I promised them there wasn't going to be any. I'm keeping my end of the bargain.
Yeah. Well, okay. Guilty as charged. Well, I blame you, Steve, for teaching me the math. So
Okay.
yeah, you were immensely helpful because so where I would start, and I realize this is probably kind of small here, but I would pull together. Okay, what are we currently doing? What are the costs of what we are currently doing? So you take your e-learning, you take your instructor-led learning, books 24/7, your DISC, predictive index, your Hogan's, try and project out approximately how many you're going to need. And, it's a very easy spreadsheet that you could pull together. This to me is what I would put together, and then I would partner with someone in finance and accounting. Because to jump from this to something that looks like this, where I have to figure out, okay, what fits into I don't know if you can see this here, the fine detail here, what fits into the G&A divisions default, postage, telephony, data. Oh my God, I don't know what fits where. And I think I'm only speaking for myself. A lot of us suffer from that anxiety of, I don't know if I'm doing this right. So I would say at least minimum first couple of years that you do this, first spitball it, first come up with, all right, this is what I'm currently doing. This is what we're currently paying. I anticipate we're going to grow, that our programs are going to increase based on need. And as also a former salesperson and somebody that used to sell a lot of products, you want to aim high. So with a lot of these, did I really need 25 Rosetta Stone licenses? No, I probably only needed 20. So I'm going to aim high because I know people like Steve are going to probably beat me up a little bit and say, do you really need that much? I'm going to knock that down a little bit. So by the time you actually get to filling out this budgetary document, you're going to have something that's going to be able to very practically account for that growth, Kyle, and manage that growth that you're referring to.
And so then I take this piece from Jonathan's area. I accumulate it along with all the other areas that I'm getting this information from throughout the company. And from that, I build a comprehensive model of what next year or the next couple of years is going to look like for the company, both the revenue number, and then of course what Jonathan's doing here in the budget is what's it going to cost me when I look at the whole enterprise.
So does that make sense?
It does, yeah, it does, especially seeing these visuals here and just kind of getting a high level overview. There are some other questions that are going to be that are obviously generating from this, but I'm going to wait and listen to the entire presentation before I ask if it doesn't get answered.
Yeah,
Sure.
right on. Cool. All right, so we're gonna now transition into the more interactive element of this presentation here, and it's starting off with this particular question.
So it's the basic question is what is the CF, of all the different people within an organization, what's the CFO focused on most? What keeps them up at night?
And folks, at this point, feel free to enter into the chat or raise your hand. Would love to hear your perspectives. What do you think the CFO is most focused on? So we have human capital. What else? Any other guesses? I will tell you that this answer, Steve gave me a real wake up call when he told me what the CFO is focused on. Certainly, human capital is part of it. Any other guesses? The future financial state, yeah, of the business. Wow. I don't know, Steve. Bianca is a future CFO, I think.
Could be. The answer is the future. And it's all of these things. We are always focused looking in the future. The financial state being one part of it. Also, our risk and performance are other parts of it. But the CFO is always looking forward, always planning, always developing models, always and touching every part of the organization that's needed to drive the organization forward. Future financial state could be also, if you think about it, I could be positioning the company for a transaction for being sold, right? So maybe the future financial state of the company in 10 years is for there to be no company in 10 years. And hopefully allow, and work on that transition, making sure that all existing personnel are able to get through the transition okay. And, it's not just a case of everybody lose their job, that type of thing. These are all things that even the non-financial things that I'm always working on and thinking about. So it's always looking forward, using the information I've received, the historical information I've received, and always projecting forward, both personnel wise, financial wise, material wise, very personal wise. In the case of, let's say, small business owners who are in a business, they have a plumbing company or something. They have that business not because they generally love plumbing. Probably it's because it provides them the means to give their families what they want to give them. So always looking forward. That's what we do.
Now there are though three particular focus areas.
Sure. Yes, the profitability and the risk to get that money or get that profit rather, and then the overall performance or efficiency of the enterprise. Can I produce that profitability more efficiently than the next guy down the street, and being constantly in that and constantly measuring those things. I'm always measuring efficiency or performance in all different areas, even measuring those things that are not necessarily financial. They all translate. We could think of all kinds of things that eventually impact the company financially, but maybe not directly, but indirectly they will eventually impact the financials of the company. So as a CFO, I'm beginning to measure those items ahead of time.
And this, by the way, T&D professionals is where you have very strong leverage and expertise. Because no offense to Steve and other CFOs, but oftentimes they are not aware of the time, the cost, the depths of the capability of T&D. So this is where you are a vital asset. You will advocate for, if we want to create this service or create this particular product, these are the talents we need. This is the approximate cost of building this capability. So you can advocate. You're the subject matter experts when it comes to building capabilities. So partner with the CFOs, get into those meetings as much as you can so you can be involved in the strategy and the building of or scaling down of. Unfortunately, that happens too. The scaling down of capabilities and maybe transferring talent out from one area that might be downsizing to maybe another capability area that has like skills and behaviors needed. Had a question come in here. How do you personally manage up with the CEO, COO to mitigate risk for initiatives set forth by those leaders? Oh, wow, Kyle, that's almost a separate class unto itself. Well, so Steve, you've been in that position. So, when people are coming to you just trying to manage up to mitigate risks and
Mhm.
talk about new initiatives, what did you respond to the most? What do you respond to the most?
Oh, I was always, I was always very an open door guy, and was always willing to listen to, um, what whoever was coming to me, and if they could articulate the risks, and then I would push back. And the pushback was not always, oh, it's too expensive. No, that was not the pushback. The pushback was cost might be a factor, and here's why. And and the true explanation of the risks. A good example would be is sometimes I would think I would know what the risks of a certain strategy were, and another person may come to me and after a discussion, my opinion might have changed of those risks, or theirs might have. Once they fully understood how sometimes not so much training, not so much the talent development folks, but sometimes you get siloed into your own area and you're not really aware of how what you're doing fits in with the whole other organization. And so you don't, it sometimes, unless somebody explains it to you, you don't understand how, well, what's maybe really good for your area may have an adverse impact somewhere else. And you just need somebody to explain it to you. Another thing along these lines is, look, I'm a data, CFOs are data people. We're numbers nerds. And one of the things that can help for you folks is we measure everything. You probably heard the expression, and I live by it. What you don't measure, you don't manage. So you've got it. We measure everything, and what that allows us to do when we talk to talent development people is we can identify skills gaps within the organization, and that's key. So when I come to you and say, "Hey, I'm seeing performance slipping in this area," and we start find out why. Well, it's because these people are not trained in some new technique or procedure that's out on the market. Oh, well, there's a skills gap. All right, I've identified the problem area, done a little research, find out what's causing it. Now I go to my talent development folks and say, hey, we have a skills gap here. This is what it is. It's a new thing we need to start focusing as we're training up people or looking for talent. That's how you take a number nerd like me who's looking at metrics and KPIs and how that translates to filling and reallocating, either getting new assets, human assets into the company, or reallocating assets within the company. Or it goes the other way too. We no longer need that skill. Technology has changed. I don't need somebody who can, I don't need somebody who is great in the mailroom anymore. We don't have much physical mail. I don't know what it is, but we always have these types of things pop in that are no longer needed. So I go to the talent development folks and say, don't need that skill anymore. We can take that out. So that's how we train. That's a lot of where I interact with you folks.
Yeah, and I'll add to that, Kyle. What has helped me win the day with the CFO is when I speak their language. So me learning about the different financial instruments, knowing what's on a balance sheet, knowing what a cash flow statement is and the different components to it. So that way I can speak their language. The worst thing I can do is go into a meeting with the CFO and say, hey, I feel that we need more money for training.
You got to bring more than that.
Yeah, the answer will automatically be no. Versus, hey, based on the growth that we have right now, so we're looking at 2% marginal growth year over year. That means that we need to hire in these particular areas, and based on compensation analysis, Mercer compensation analysis, this is approximately what we're going to need as far as wages. We're going to need this amount for wages, accounting for inflation and things like that. So being able to have that financial literacy is going to go a long, long way. And again, CFOs love it when you educate them. When you say, look, for us to upskill somebody, this is what it's going to take. They're going to need to go to this certification course, which is going to cost $2,000, and we need 10 people to go through that. So, we need to allocate for the 20 grand. So being able to know your stuff, know your numbers, but definitely financial literacy goes a long, long way. And the biggest complaint I heard from people in finance is the folks in HR, the folks in T&D, they just don't know finance.
Well, and a lot of
So
what that is right there, Jonathan, a lot of there is the reason we even have this whole course is because it's a lack of communication. You've got two different departments that speak an entirely different language. Their cultures are different. The language is different. So the communication is poor. And now you get performance issues.
yeah, I had one banker tell me it's capitalism versus humanism,
Mhm.
and they go head to head, and it doesn't make any sense because we're on the same side.
Right.
We're both trying to do the same thing. It's just abdicating, being able to abdicate from those two positions. Well, excellent. So we're going to start into a little bit of a quiz section. So this is your chance to be able to win a lucrative prize. And let me share my screen here. So that lucrative prize is going to be. Hopefully, you all can see my.
Can I interrupt you there real quick, Jonathan?
Yeah, yeah, go ahead.
Because I'm looking at the comment that Bianca just put in there, and this brought something else to mind. That um, um, it's not exact. What this reminds me of is resistance to change. Sometimes we run into. It's not exactly what her comment is, but sometimes resistance to change or risk aversion can be as detrimental to a company. Well, it is because you're always got to be moving forward or backwards. You're never standing still. And if you're so the idea is, can you measure risk? Can you accept a level of risk? And if you don't accept the level of risk, you're going to be standing still, and your competitors who are and can do it intelligently are able to move or will move past you, and then eventually you'll go out of business.
Yeah.
So risk is not a bad thing. Risk is something to be managed.
Yeah. Yeah. Balanced, managed risk. Yep.
Mm-hmm.
Okay. So the lucrative prize is that whoever gets the most points on this quiz that we're going to go through, you are going to get a free disc assessment and a free coaching session through one of our executive coaches. So that's what's at play here. All right. So, and I will say Bianca's already won a point because she said the CFOs are focused on the future. They absolutely are. So, we'll go through the first question here. So, what are some hard costs associated with hiring and training team members? And if you could please, this is not going to be a poll. This is a small group, so I figured we would just keep this more interactive. Please put into the chat what you think are some hard costs associated with hiring and training team members. And I'll track the correct responses. Okay, so we have Kyle already with salary. Let's see what are the responses. So hard costs associated with hiring and training. Feel free to take a stab at it, folks. We won't think of less of you. Oh, membership dues for 18D. All right, Shannon. All right. Materials. Yeah, hiring. So assessments. Oh, man hours for interviewing, oftentimes overlooked. HRIS system processes, new hire packages. Yeah, I think Bianca's hitting the nail on the head there. So benefits. I don't know, Steve. What do you think? Would benefits be a hard cost?
Sure. Every time
Okay.
you bring in a new, it's a hard cost. It's a hard cost of obtaining a new member, a new team member.
Yeah. So recruitment costs. So Michelle hadn't mentioned recruitment costs. Yeah, advertising. So those, I believe, and Steve, take a look at the chat. I believe all of those would qualify as hard costs, correct?
Yes. Yes.
All right. So on the leaderboard right now, we've got Kyle. Of course, Kyle sneaks in one additional one just for another point. But we've got Kyle with 3 points, Bianca with 2, Michelle with 1, and Shannon with 1. All right, excellent. So now for the second question. So what are some soft costs associated with hiring and training team members? Soft costs. So slightly different here. Soft costs. This is a little bit more difficult. Things that we often don't think about. Downtime from, oh yeah. Absolutely, Kyle. Yeah, downtime, loss of productivity. What other soft costs? Supplies, well, Bianca, I think that would be a hard cost. Correct me if I'm wrong, Steve.
Yep. Soft costs would be items that are very difficult to put a dollar amount on.
And productivity would definitely be one of them.
Mm-hmm.
Anybody else? Time spent onboarding. Yeah, I think so. Yeah, that qualifies. Way to go, Shannon. Firing poor hires. I think that qualifies.
Sure.
I think that qualifies. Yeah, and Doreen, onboarding, and do you mean the time for onboarding? Yeah. Okay. So that I would say the time for onboarding, yes, absolutely. And also, I had Shannon with mentoring hours. Yep. And Nina, yeah. So Nina had captured that too. Time for onboarding. Yeah. So the time spent for interviewing, absolutely. Sometimes very difficult. Learning curves. Yeah, Kyle. You know, I've been asked by CFOs many times, okay, so what's it going to cost to get this person up to speed? Okay. I could guess at that. I can't give you a definite number on that. It's a
Well, no,
guesstimate.
that's why you can't ask what it's going to cost. What you would say is about how long is it going to take to get this person up to speed.
Yeah.
Remember, even the greatest rock star in every organization wasn't a rock star on day one.
Yeah. Oh, so Shannon asked the question, where would PTO go? Is that a hard or soft cost?
That's a hard cost.
Yeah. Typically,
Now,
that's budgeted at the beginning of the year. Typically, right?
yes,
Steve?
it is. Right. Yeah, because most organizations have a pretty standardized PTO plan of some kind. So we budget that.
Okay, excellent. These are great. Love your responses.
Kind of related to that, another soft cost might be you wasted materials that were acute that you wasted materials for somebody who never showed up for the training, or guy calls in sick, and you've got you've put booklets together, things like that. Now, well, there's a fixed cost associated with that. It's an opportunity cost, I guess is what you would call that, because now you still have to train that individual who didn't come in. So there's an opportunity cost associated with that. The other thing is that I'm becoming hypersensitive to, especially with we'll call it the new workforce, is it's incredibly important that people's job satisfaction is as high as possible. And that directly, there's a lot of things that impact job satisfaction, but I believe that, and I think most of you do too, that it's the training and development of those of new personnel and existing personnel, their ongoing continuing education and things like that, that improves job satisfaction, which then improves job performance, which then eventually trickles down to real net income for the organization. So those are types of things that soft costs that I focus on.
Yeah, and that I think dovetails too into the employer value proposition in general. So when you're talking about, we as an employer, we have a great culture. Concepts of culture, concepts of we develop people, we invest in you. I mean, there's hard costs that are associated with that, but there are often soft cost impacts when you don't do it well. Did I articulate that right, Steve?
Right. And then something else I'd like to just throw out there as an aside is I think that most people coming into the workforce today really want to know what their career path is within the organization. If you don't show them a career path, they will leave. And articulating that career path and being able to show that to a new employee, that development of that career path is really should be done, in my opinion, by many members of the executive team, HR, and talent development. And they should be able to clearly articulate what a potential career path for that individual is. The benefit is, well, obviously, if you don't show it to them, they're going to leave at some point. Sometimes if you show it to them and they don't like the vision, they won't waste your time anymore at all.
Yeah,
which is also not a bad thing.
This is coming from a CFO, by the way. So if a CFO is aware of these hard and soft costs of T&D, then certainly the rest of the organization, part of our charter as T&D professionals, is to advocate for this, to talk about the hard and soft costs. Now, Doreen had asked a question, what about the content subscriber usage? So if I'm assuming, Doreen, you might be referring to like e-learning programs, things like that. Maybe you've spent a lot of money towards them, but people really aren't using them.
The answer to that question is it's kind of a hybrid hard or soft cost. It depends on how the structure of the payment for that is. If it's a by head, if it's a per head cost you're paying, obviously that's a hard cost. If it's a package you're offering, you get, let's say it's a monthly, there's a monthly cost for, maybe there's not a limit on the number of people you're running through it. Well, then now it becomes to move a little softer, right? Because you can't put a per dollar charge per head on it. So it can be a hybrid in there.
Gotcha. Okay, so let's move on to question number 3. And so far on the leaderboard, it looks like we've got Kyle with 7 points, Shannon with 3, Bianca with 2, Doreen 1, Nina with 1. Or Nina. Nina. I hope I'm pronouncing your name correctly. Okay. Is debt bad for an organization? Feel free to put in chat. Not always. Depends. Not always. I don't know, Steve. This is a pretty smart group.
It is. Debt is neither good nor bad. It's a tool. You get it. I mean, anybody who's ever gone and bought a house with a mortgage goes into debt willingly because there's a long-term benefit there. So it's the same with a business. You use debt as a tool to jumpstart the progress to where you want to be. Now, like your personal debt, too much of it is not good. But using it properly and managing it, it's just fine.
Yeah, so it's a little bit of a trick question. All right, so this one might be a little bit more challenging for you all. What are some assets of a company that don't appear on the balance sheet? So assets that don't appear on the balance sheet. It's a little tricky. External investments?
No, they would
I think
appear.
that would appear.
They would appear.
Yeah, they would appear. Customer
Yes.
loyalty, yes. All right, Michelle. Now you're cooking with grease, as we say in the South. So what else? Assets that don't appear. Okay,
And this is on here too, brand recognition. Yes. This is on here because these are things that the CFO has to also be focused on. Yes, client satisfaction, absolutely.
Yeah, engagement. Yeah, Shannon, that is, we can measure engagement, and it is one of those things that we don't like monetize. It's not, we don't necessarily track that on any financial instrument. And yes, Bianca, way to go. Kyle, what do you mean by ratings? Like NPS scores? Yes. Okay. Yeah. Customer. Yeah. Yeah. I would say that qualifies. Now, or feedback from reviews. Yeah. So you've got like Glassdoor and Indeed and that kind of stuff. I think you might be referring to that as well. Now, there is one that I think all of us should be very aware of, and that is the value of talent. Performance reviews, I'm not sure that wouldn't show up, Bianca, in any sort of budgetary guidance. But by performance reviews, you're talking about like, people's capabilities or how well they're performing overall. Then I think maybe that might be somewhere linked to a bonus. Perhaps that's very fuzzy. I don't know if that would, but yeah, it's a bit fuzzy. But value of talent, and Steve and I had a little bit of a debate, an email debate about this because we do track labor. We do track labor. But what we don't track is the value of that labor. In other words, the certifications that they have, the unique skills, the unique capabilities that they have. We don't monetize that. There's nothing on a balance sheet that says this is the value of somebody having their PMP certification. Ooh, social responsibility or community service. That I think definitely qualifies, right, Steve?
Well, yeah, because that gets into what I would call the business reputation. And that is a lot of these feed into that category of business reputation.
Yeah, the three main categories for this, the assets that don't appear on a balance sheet, the three main categories are the value of talent. Value of talent, we don't track that. And as T&D professionals, we need to make the organization aware of the value of talent. Culture, again, we need to be the advocates of culture and the importance of having a positive culture and the recognition that goes along with it, the Indeed and Glassdoor, ratings and things like that. And also business reputation. So, as Kyle had mentioned, social responsibility. Nowadays we have ESG scores. So ESG scores are starting to tap into that a little bit, but that's not as widely accepted yet. It probably will be any day now.
As soon as guys like me die out, yeah.
Well, I'm in the same class as you, my friend. So excellent. Okay, so we've got time for a few more. So the final one, What are some metrics? So you guys should be on all over this one. Metrics can be tracked to evaluate the return on investment in training and development programs. So how do we track ROI in training and development? Goal achievement? Yeah, I would say that that qualifies. What else? Come on, folks. I know you've had to do ROI for this. Supervisor reporting. Shannon, could you say a little bit more about that? And performance reviews. That, yeah, so changes in performance is definitely an ROI.
Performance reviews is interesting, right? Because that what you're doing in a performance review is oftentimes you're taking subjective criteria, you put it into a performance review, and out comes the other end is an objective report, oftentimes with some sort of scoring system thrown into it. So, and that's a metric to be measured.
Yeah. So typically, I will tell you this: performance reviews, when they're done, when they're measured year over year, when we see that, okay, somebody used to be at a, let's just say, a 2 out of 5, and then they go to a 4 out of 5, and you see in between there they received coaching and they received training, and also their productivity increased. They produced more widgets. Yeah, that's a definite ROI. Impact studies. Did sales increase or customer? Yeah. So Michelle, Michelle, you hit the nail on the head right there. Operational efficiency. Yeah. Sales goals. Yeah. If you can see like year over year change in sales achievement due to a training and development program like sales coaching. Yeah. I think Bianca gets a point for that one there. Supervisor confirming that changes have been made. So that's okay, Shannon. And here. So Steve, let me ask you as a CFO, when somebody says, "Hey, trust me, this training worked. I saw a difference in the employee's behavior and/or productivity." How do you take that?
You got to show me. You got to show me with some kind of a metric, something I can measure. Again, what I can't measure, I can't manage. And so we do a lot of this. And actually, there's a big one I haven't seen come across as an answer to this question. There's a very basic one that is easily measurable, and tells me or leads me down the path. It doesn't tell me if the investment is worth it in the T&D, but it does tell me if I've got a problem there. And that's turnover. We just talked about all the costs.
Somebody did mention that, but
did they? Retention. Yeah. There you go. Yeah, all the costs we talked about, hard costs and soft costs that go into bringing somebody on board and keeping them. You want to keep them.
Yeah, it was. I think Michelle had mentioned that first.
Unless they eject themselves from the organization.
Yeah, that's spot on. Yeah, spot on. That's usually one of the biggest ones that we look at is employee retention. If employees are leaving, of course, could be a lot of factors for that. But nowadays, I think we all know the expectations of the younger workforce is, as Steve mentioned, career. What's my career trajectory? And how are you going to develop me? What's my development plan? Excellent, excellent.
Okay, so I have like a quick question. I know we're running that short on time here. So I understand the retention, the turnover ratio, right? However, given the current state of things, we have 5 different generations in the workforce currently. Well, you have the silent generation who won't leave no matter what, right? They were always taught stick to a job and you stay there until they give you a turkey and a gold watch. Then the newer generations are like, I want impact, I want significance. So how do you balance that dichotomy, in reviewing that as a potential metric? Because it sounds like it has the potential to be skewed based on the generation that you were brought up in. Hope that makes sense.
Yeah. So I'll let the CFO answer that one.
Well, I think there's some training both ways, right? I think it's valuable for folks that are engaged in the development of new talent coming onto an organization to also develop some programs uh, that are aimed at the existing old talent like me, um, explaining to us uh, how what they're seeing on the street is how people are communicating. How, what do people want? I've had to learn over the last, especially the last 10, 15 years. I've had to keep up with how the workforce is changing and their wants and desires. Uh, if I don't change the way I look at things, or at least understand how they look at things, I don't have to agree with it, but I have to understand it. And if I don't do that, I cannot be as successful as a leader of an organization. And because then again, I'm not talking their language. There's a flip side. That doesn't mean they also have to learn to talk my language too, right? Both sides have to learn a little bit about how everybody, what drives and motivates everybody. Don't have to agree with it, just have to understand it.
Yeah, that's, Kyle, you kind of hit at the question of our age right now. So uh, ultimately, how do we grow as individuals? How do we grow as an organization? It's through us learning from each other. And, the young generation has as much to learn from the older generations. Um, Now, when it comes to the world of finance, I don't think that the world of finance is really going to change because it really works. Um, it, it really does. Our capital system that we have works really well. So it would really benefit young people to understand these underpinnings of finance. So that way, when they do have a great idea, when they do, here's an innovative approach to our product, they can put together a business plan that the CFO would understand and endorse. This would engage the people further. I mean, that's what at the best workplace, we have a talent incubator program, and that is really critical, we feel, to developing the future. Kind of think of like a Shark Tank, right? So, being able to come to an organization and develop an idea, the marketing of it, the finance of it, the business proposal, the presentation skills, all that kind of stuff. I think young people need to be able to learn so they can build and develop these ideas. Okay. Unfortunately, we only have a few minutes left. And so I just wanted to say that, Kyle, congratulations. Let's give Kyle a round of applause. He clearly won the most amount of points. So, Kyle, I would ask if you could please, if you're comfortable with it, just put in the chat your email so I can follow up with you. And also, what I would ask all of you to do, and I'll share my screen here, is we would, of course, love to hear your feedback on this program. And let me share the screen here. So here I will put into the chat not only the link, but here's the QR code. If you could please, give us feedback. We would appreciate it. And if you pop your email in there, we will share this deck with you, and we'll also share a short white paper that includes the answers to all the questions that we just discussed in a little bit more detail. We weren't able to go into as much detail. And certainly if you want this program, either the half day, full day, or 2-day program brought to you, we can certainly make that happen.
We can
All
even make
right.
it happen live.
Oh,
If you're
yeah.
up for that.
Oh, remember those days.
Yes.
Remember those days. So with that said, thank you so much, folks. We really appreciate your engagement. Great questions. And if you do have any additional questions you want to reach out to us, I'm going to put my email. And Steve, if you don't mind, if you could plop your email into the chat as well. Because this is, I will tell you, financial literacy is extremely important for you to be able to advance the great causes of T&D. So my email's
Where's
in
my
there.
chat? Here we
Steve's
go.
popping his in. Please feel free to reach out, and Kyle will be reaching out to you to schedule your disc, as well as the coaching. And please, folks, feel free to reach out to us if you do have any additional questions, comments, concerns, even sarcastic remarks about, CFOs. We accept those too.
And hey, Jonathan, so it's okay if you want to give someone the disc profile. I'm actually disc certified. I actually teach
okay.
it.
So all right. Well, in that case, then the runner up. Let me look here. The runner up was Michelle. So Michelle, if you don't mind, if you could, just feel free to just individually send me your email, and I'll follow up with you, Michelle.
But I still want to talk with you, Jonathan and Steve, please. I do have some other things that I'm thinking about outside of what's going on here, and I would love to get your insights, see how we could possibly connect to do some other things. So I've got some other things that are on the table right now with some nonprofits and some other organizations. I think your program might just fit with what we're doing on a larger scale, both domestically and internationally.
Fantastic.
Oh,
I'll be happy to
fantastic.
give this program somewhere in the Caribbean. Be nice.
I actually just completed a disc profile at work, so.
Oh, okay. Well, in that case, let me see. Shannon would be. Oh no, actually Bianca. So, Bianca, if you wouldn't mind sharing your email. Boy, disc is popular. That
It's
means
a
that
great tool.
it is. I agree with you. I'm a huge advocate of the disc. So Bianca, if you don't mind, I think you were the next person up. So just share with me your email, Bianca, and I'll follow up with you. Or if you just want to pop your email into the that Survey Monkey that I sent. Yeah, you guys are.
I like that. It's Bianca with a K. That's good.
There we go. Gotcha. At Mohawk Kind. All right. All right. So Bianca, I will be following up with you, and everybody else. Again, feel free to reach out if you want to bring this, the 3-hour, 6-hour, or 2-day program to your organization. All right. So with that said, I bid you adieu.
Guys, have a great week. It's been nice talking to you.
Have a good one.
Thanks,
Thank you.
folks.
Bye now.
Thanks.
Cheers.